Price stocks continue their up and down pattern this week. Today was the up day, and reversing really some weakness that we had yesterday and then some. So we had a really good move to the upside, setting ourselves up for what could be a good end of the week return. So we kind of break down, first of all, whether I expect we will move up again tomorrow into the end of this week and beginning of next week, or whether or not this is the extent of the rally. We'll take a look at some old precedents. We'll also take a look at what it would mean if we actually did break up to the upside and followed up today's rally instead of the up-down pattern, but actually do an up-up pattern and get another really good return tomorrow. So we're going to break that down, how that would look in terms of a new bullish intermediate trend starting. That would be the goal, right? That's the hope I think we all have. But of course, we all know that the patterns we've been seeing that suggests that might not be the case. So I'm going to break it down how those two kind of jive with each other and what I expect will end up happening and what's driving the action we saw today, along with our trade idea stock that's just been kind of going nowhere in the consumer area, which has been relatively stagnant. And we'll talk about how to trade that stock. So let's go ahead and get started. Today is Thursday, August the 8th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Alright, if you're following us on our blog, check out some of these things over here on the right, including our Market Outlook live video. And this is where I take a look at old trades, see whether or not we should stay in them or get out of them. We also put on today's trade before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here with this thumbs up icon. Click on that. It opens up that tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a nice good update today, up to 2.3% on the S&P. It brought both the near-term line and the momentum line higher. Again, the near-term line is not above 80. This would be the second day of the near-term line being above 40. So in the second day, it generally should get above 80. Even if we say, okay, this, that was only 41, so maybe this is the first day. Again, we have that same phenomenon we talked about yesterday, where the momentum line is not higher than the near-term line on that day. So it introduces the likelihood of a bearish near-term peak, like the last three near-term rallies that occurred when we have that same phenomenon. Again, a rare pattern when it happens, and this happens now 4 times in a row. And when it happens, it generally, because it's rare, because we're generally more bullish than we are bearish. I mean, if you look at this chart, there's generally going to be, even if I zoom out for some more context, where we have some bearishness, even with a correction here, you can see there's a lot more green shading than pink. So we're generally more bullish. More often, we're more bullish than we're bearish. That's why it's a rare pattern when it happens. And like I said, this would be the 4th time in a row that that's happened. Now, that doesn't mean that it's going to drop tomorrow. But it does increase the likelihood, right? They increase the odds of another bearish peak, whether it's tomorrow or Monday or early next week. We are still 3% below the 30-day moving average. Obviously, the moving average is falling, so even if price stayed the same on Monday, that's going to move up a little bit there. But I mean, that's a significant level. So I mean, we've had a pretty good run off of the low point here. 51.19 up to 53.19, so a 200-point rally off of this. In fact, when you look at it on the zigzag chart, it's a 2.5% move, and you can see you get these 2% rallies plus rallies during these intermediate declines. In fact, we've already had one last week while I wasn't here. We had a 2% rally to the upside, right? 2.25% rally to the upside, and it failed. Remember the bearish near-term peaks. And we fell down lower. Now we're getting another 2.5%. We obviously did not get one there. You can see we had a couple of them during that pullback. Then you have some of these other pullbacks. We had a 2.5% rally during that pullback during the banking crisis, the regional banking failures. We also had a pullback here at the end of 2020 2, which also had a 2% rally in the midst of that pullback. You can see all the pullbacks during the correction there. The pullback that we had in 21 right before had a 2% rally in the midst of that pullback. So it's not uncommon at all to get a move off of a low point. Remember, we are still very extremely oversold. We were, at least on Monday. So that's the kind of move we can get when we're extremely oversold and still be 3% below the moving average. And that's the same, of course, for the NASDAQ 100 as well. Again, we are 5.5% below. You can see that's lower still than we got over here when we were 5.4% below, and we had clusters. All right, we had 2 clusters in a row going into expiration. So kind of gives you a sense. This one over here, again, when we had clusters, we were only 4.9% below the moving average at the very end of that move with clusters. And now we're off of the lows, but still lower than either of those 2 peaks. So it kind of goes to show, again, just how bearish we were on Monday, that we can have this kind of a rally and still be pretty darn bearish. Obviously, the near-term line, same thing we saw in the S&P. It was actually a lot higher yesterday. It was at 48 instead of just barely at 41. So clearly out above 40. So this would be day 2. And again, failing to get above 80 on day 2 suggests, again, an increased probability that will form a bearish near-term peak and fall over again, whether that's tomorrow. I expect it would be sooner rather than later, so tomorrow or Monday, that we get any kind of move lower. If not, if we break through these highs, which could very well happen again as early as tomorrow, then that's going to be a really, really good building on this move that we had here today. That'd be really, really good for the markets. Let's look at the Russell 2000. Remember, that's been kind of doing its own thing. The near-term line has continued up above. Yesterday it was at 47. So this is day 2. And again, your momentum line still, it's off of extremely oversold levels, but still below the near-term line. And you're still below these, this week's highs, essentially. We do not have a red line yet, though. We have dark pink shading. You can see that momentum line, the 6-week moving average is pretty stubborn. It's not rolling over. That's the only index, because the Dow Jones Industrial Average, which is kind of behaving similar to the Russell, has rolled over. Though it did pop back up here today with the move that we've had. 1.75% move again. The near-term line did not get above 40 yesterday, so this is the first day, and it does have the momentum line above it. So this is the most bullish index out of all of them, and like I said, a move back above the moving average by tomorrow to finish off the week, to break through these highs and fill in some gaps here would be tremendously positive for the markets. But filling in Monday's gap. Let's take a look at the weekly chart that we have here. You can see again, it's not as big of a weekly candle that we've had. Remember, this is measuring the body. The low point still static because it's the low point of the week. The close is what changes and what makes the body bigger or smaller, because the close is the average of the open, high, low, and close of the week for the regular weekly candle. So, but still, even at this level, it's still a pretty low, pretty sizable candle, getting bigger than any of the other pullbacks we've had since we hit the washout low of that last correction. And we are below the 10-week moving average. That PPO is falling, so we'd have to kind of really change things around. But as of right now, we're at 53.41, 53.4, somewhere in that area will be where we open next week, and we're currently at 53.19. So there's a good chance, borrowing that we don't, retest the lows tomorrow, there's a good chance that we can get a much, much smaller candle, potentially a transition candle next week, back up to a bullish level. Let's take a look at the 3 green arrows. Of course, we've been having 3 reds. There's still 3 reds across the board, even though now the Dow and the Russell have yellow lines instead of red. But these other 2 are still so far red, and at least the histograms for all the major indexes are all rising, so that's a positive sign that we might be getting a green arrow in a day or 2. We might be closer to a green arrow on the moving average here for the Dow. Obviously, it would take a tremendous move for the NASDAQ or the S&P to get the green arrow on the moving average. When you break these down into their 2-line versions, for the S&P. We're still we're sitting right at the 8-day. Remember, we're not really bullish until we've crossed the 17 and the MACD has crossed its moving average. So we've had, look at this kind of move that we've had just to get to the 8-day. Again, goes to show, especially at the open, just how bearish we were on Monday. We were so far below these moving averages that when you're below moving average, especially the very short term, that's the mean in this case for 8 days, and it is exponential. So it weights the more recent days and gives less weighting to the first day in that 8-day period. But still, you're going to move. You're not going to stray too far. If I were to show you that PPO for where we are relative to the 8-day moving average here, again, you can see just how deep we were on Monday, and this was at the close. But if I were to zoom out for some context, so you can kind of see just how big of a move that is. Again, you have to go back to 2022 correction. So again, that's how deep we were, and even over here, as soon as we got that deep, similar to where we're at right now. So where are we at right now? We're at we got down to 4.05. Well, if I were to zoom out to the early part of 2022, when we got to 4.34, you can see we went immediately back up to the 8-day and then some, right, and failed at the 30-day, and that was that 6% 4-day rally here. So that's kind of what we're seeing right now. We were so far below, and we have snapped back. The question is, how far will we snap back? Will we snap back in the other direction like we typically do, right, where we swing from being below it to above it, below it to above it, right, below it to above it, when you're at these deep levels, below it to above it. And so that would require, obviously, another day to follow up today, another day to the upside tomorrow, so we can get back up above it and get this particular PPO back to being positive. Let's look at its, let's see here. Yeah, the DMI first. We'll look at some of these other oscillators. Again, the DMI has been pretty bearish, still is. ADX is still pretty high. We're still above 30 on the negative indicator, even though it's been falling. The positive indicator also fell today a little bit, still well below 20. Looking at the RSI and the CCI, we're back up to above. We're not above 0. We're not back above a positive 100 yet. So we're not at bullish levels, but we're not at bearish levels anymore either. So we're back above 40 on this too. Again, it's even with it, even though it's not at bearish levels anymore, it's still red, right? It's still bearish until we cross above 50, and then crossing above 60 is what really changes it, the color to green. So we got to cross at least above 50 first, and not just for one day like we did last week. Again, with that 2% rally we had last week, we got above 50 there and it failed, right? You got to get above 50 and then confirm it by getting above 60 like you see in these other green bars. But the nice thing is this rally has brought this negative, we're at minus 86. Remember, minus 100 is the key level. So breaking below minus 100, especially minus 150, is really what kickstarts that correction into bearish mode. And as of right now, we're avoiding that. Again, going into tomorrow, one more day left. And then, of course, next week being the CPI week. If you look at the Ichimoku cloud, again, we are still in the cloud, so we're holding the bottom of the cloud so far for support. We are still below the green line. We are still below the blue line. The green line is below the blue line. We still have a negative rate of change. We still have a intermediate strength bearish trend. Again, when you are bearish on a typical pullback, that's usually about as we don't get. You can see on all these others, we don't typically get anything more than intermediate trend strength. We don't get generally up above 80 for too long, or below minus 5. That only happens again and it's brief, but only happens during corrections. You can see if I were to go back a little bit further, so you can see 2018, more of a normal correction. You can see it doesn't get above 80 for too long on the downside, but it can briefly. And so, but your pullbacks, you typically don't, just your typical pullbacks. And as of right now, that's kind of what we're seeing here. So far on this particular chart, it's kind of showing that this is, like this one over here, just a typical pullback. Again, so far. If you look at the Bollinger Bands and the Keltner channel, Remember, we were in the lowest quartile for multiple days. We're back out, but still in the lower half. The bandwidth still rising. Remember, I told you this does suggest that we are in more of a correction mode, because typical pullbacks don't get the bandwidth up to 10 or higher, and we are not below the Keltner channel anymore. We were yesterday. We got back above it today, and you can see the momentum. Because of that, the momentum line has turned yellow. So we might be starting a move back up towards zero on the momentum line. Again, we have to kind of get above in the upper half of the chart to feel really good about upper half of the bandwidth to feel really good about the beginnings of a new bullish move up to the upside. And then let's take a look at today's intraday move. Higher high and a higher low. We did not get a new higher high though. We did not close above yesterday's high. We didn't get a new higher high either. There was a higher low point, and there's a gap there, and there is some possibility. It doesn't look like the best runaway gap, but there is a possibility, because that was a pretty sizable gap. Second straight day of a 2 standard deviation gap to the upside. This time, instead of finishing negative, we did finish with the biggest gain that we've seen since 2022, the end of 2022. So, that's a pretty sizable move. So there is, a possibility that that's a runaway gap that we don't fill back in based off of those. Just glancing here, it doesn't look like that's a runaway gap. It looks more like a common gap like we've seen before, even like this one over here that we still haven't really filled in all the way. So, we still, in my opinion, are still susceptible to filling in those gaps until we get, if we were to gap up, say tomorrow, say up to maybe 536, 535, then you're kind of breaking through these, these old highs and these two highs, and then you have a better possibility for a runaway / breakaway gap at that point. Again, a gap that starts intermediate trends. That doesn't get filled in sooner rather than later like common gaps do, which, again, I do believe that's what we've had on Tuesday, and then again this morning. Obviously, yesterday's was a common gap too, because we ended up filling it in by the end of the day. We are still, waiting for the green line to hit the 0, the red line to drop below 70. That usually sets us up for the breakout move to the upside. So we're not quite there yet on that. Let's take a look at today's volume and trading range. We've been getting really strong volumes. Today's range it's also been pretty strong. We've had a 13.5 point range there, 11.88. This was 13, not including the gap. So we've had some pretty big gaps. So this was 15. This was 8.3, again, not including that sizable gap. So we've had some really, really big ranges that brought the ATR up. Well, now we can't, this was about an average range considering the current high level ATR, and the volume ended up being less, and you can see the volumes tapering off there. So when you put those numbers into context, we are still we're right there. Again, very, very high level. Again, we haven't had this high of a level of ATR in a while. Going back to 2022 was the last time that we were up this high, whether on an absolute or a relative basis, which is better to look at it on a relative basis. This is a pretty high level, and you can see where the volume is. The money flow, which is kind of a better way to look at that volume there, is still, in the lower half of its chart. I told you before that the money flow has actually been pretty positive here. It hasn't been nearly as bad as you would expect, considering how far we've dropped. And so, this is a good opportunity for us to, get some money pushing us into the upside and getting that breakaway gap with some good volume or / runaway gap, and really feel good about the beginning and break through moving averages like the 17-day and feel good about that new trend starting. So until then, again, the odds are that this 2% move will be similar to last week's 2% move, or it fails and rolls over. But if we can build on it tomorrow, then it can really change the sentiment and change the expectations and set us up for a new intermediate run. However big that intermediate run ends up being. Again, they tend to not be as big when you've had the deeper pullbacks versus, say, the shallower ones that we had right there. All right, now let's take a look at the VIX. So the volatility, the VIX is another interesting. Obviously, we're not below 20 yet. And we spent most of the day above 100% relative to the VIX 3M until the very end of the day. So a big drop down. So we did make it below the 100% level. So when you open above 100% and close below it, that's very bearish for volatility. So that was significant for us to close below 100% because that's a bearish pattern. You can see the VVIX drop down too. It's still pretty high at 134, but that pattern there, right there, is very bearish for volatility and is a very good sign that we might have settled into this low and bounce back up. So there's some really good green shoots developing, and whether or not we have enough, I don't think is likely, but they're definitely there, right? And we have to account for them and be aware of the, in my opinion, lower odds that we're done. That this was just a little bit deeper pullback than normal, and now we'll go up to new highs and then some. I think that's a little premature to say that, but there's definitely some green shoots that suggest that that's the possibility that could occur. Again, we'll probably know as early as tomorrow, unless the market just like shuts it down, like it has done in the past going into a CPI report. Usually the market, when there's a few days left, will shut it down and just go completely flat. The issue with that, which I don't think it was as likely this go around, is you have a high VIX. So the VIX would have really collapsed if that would have been the case. Anticipate, if everything were to really shut down there, and obviously that hasn't. All right, now let's take a look at what's driving this price action here. So let's pull up the asset class comparison chart and just look at today alone and take a look at today's moves. Of course, the major asset class we've been paying close attention to, or especially lately, is the bond market, which again, this is 4 days in a row now, going into the 5th, that the bond market started the week really high because everything started low, but then you can see the rest of the week has really come down, which means yields are moving higher. The yields have really made a move back up to the upside. Here, let's pull up this chart and we'll pull up the 10-year yield. Right, this is, again, up to 4%, a big round number of 4%, also moving averages there, big gaps between the moving averages, so it's going to be, really hard to break. I mean, these are going to act as resistance levels. As you can see, the 8-day can act as resistance levels to the upside, and, through the upside and the downside, or support to the upside, resistance to the downside. So that's a big move that continues to be helping markets. Remember, stocks and bonds are negatively correlated with each other right now. So the more it drops, the more stocks can rally. Generally, it's been positively correlated, but it has grown more negatively correlated. And you can see commodities turned up as well. They've had a good day. They had a good day today. Dollar was relatively flat, but commodities bounced back up, and commodities have been relatively weak, right? And you can see had really dropped down, broken below to new 52-week lows, broken below that point of control, which now we're sitting at, as well as short-term moving averages. And so, that's going to be a key for the markets to be bullish going forward, is the commodity index to really break out to the upside. As again, you can see stocks and commodities tend to be pretty positively correlated, and so if we're going to get a move higher in equities, we need commodities to move higher too. You can see there's 85% correlated there. They're still really embattled, and they're also still in a bearish seasonality pattern for the rest of the year, for that matter. So that's going to be something for equities to have to overcome that relationship. You can see international equities did pretty well, but of course the Qs and the Qs being really the biggest winner, as you see a lot of these Magnificent Seven stocks, all of them up today for the most part. All of them, I think just about every one of these 12 stocks were up today, but you can see they're all so far below moving averages. You can see how if you look at the size of the candles, these are some big moves. 6% move on Nvidia, but you can see, look how big that candle is compared to what we've seen. Same thing with Google, up 2%, and doesn't look like it's really changed. Really, Meta is the only one that has broken through its moving average. Everything else AMD down here up 6%, but it looks like it's barely moved at all. And some of these others too. Amazon up 2% also looking. So a lot of this really significant rebound in the Qs is mainly because it was so oversold over the past few days. Now, breadth, because of the move, it was actually more than just the Mag 7. It ended up being a pretty good move in the Russell as well, and other breadth. So we ended the McClellan oscillator really moved up. Now, it didn't go positive, but it really moved up from these relatively low levels that we had. So that's a very positive sign for the markets as well. In fact, when you look at the number of stocks that close above their 50-day moving average, let me get that up here and move that over to this side so you can see it. There we go. So right here, the number of stocks that got it screamed higher today, so it ended up getting well above 250, got up to 274. Now again, not back above 300. That's kind of the level that signifies, that we're back to being pretty bullish again. But especially considering that we never did drop below 200. I mean, this has been an 8.5% decline. Like, we only dropped 5% here, and we came off of much higher levels in terms of number of stocks above the 50-day moving average at the start of the intermediate decline. And we did drop all the way below 200, and we haven't done that here. So we've fallen like way more, way faster, and we haven't had the big depth, right? The big drop as we do every other. I mean, even... again, going back to some of these other, like we started this intermediate decline with the banking crisis at about the same levels as well, just over 350, but it dropped way below 200 during a very typical, and of course this intermediate decline from last summer got well below 200 and stayed down there for a long time. So it looked very much like a correction type move. So this one so far, this one, even this like token 5% pullback from 2021 got below 200. So that's why, again, it's another sign that I don't think necessarily that we're done yet, because we haven't really had like the big washout move from a breadth standpoint to say, okay, we've really gone down and now we can really bounce, right, with some force, not just a 2% move bounce, but again, like a 5-6% move in a very short amount of time. Because we have a lot of, we've washed out a lot more than what we have had this go around. You can see the new highs and new lows index is still negative, right? So even as positive as we were today, really over the last few days, we obviously did come off of the low point on Monday where we were at 724, but we're still pretty negative despite 3 decent days here. Over the last, for the rest, especially today being a pretty decent day up to the upside. And the average is, we're way, not only below zero, but we're way below the average there. And if you look at the skew, which is something else we look at as well, interestingly enough, jumped up above its average, which usually ends these moves. But usually, again, even on the token pullback like we had there, and the token pullback we had in 2021, the average gets a lot lower than. So this is like the lowest average of any pullback that we've had, getting only down to 141. So the skew has already jumped up, which again suggests that there's still a lot of demand for fat tail risk, even though we've gone down 8.5%, which means we might not be over with the type of this. We might be retesting Monday's low point. Obviously not by tomorrow, but sometime potentially even early next week. Let's take a quick look at the sector moves and how they performed here today. So let's look at the sector comparison chart, and then we'll take a look here just today first of all, and then we'll look at the whole week that we've had. So we'll go 8. So again, you can see, not surprising to see technology, NVIDIA, Apple, Microsoft, right? Those big three are in this particular sector up almost 4%, 3.75%. This is the only sector that really outpaced the markets. Industrials did barely. Discretionary came in just a little bit below it with healthcare. Your safety trades, staples, utilities, even though interest rates were up, so it put a little pressure on them, but they weren't negative. Is kind of what I was meaning to say. But they did underperform as you would expect they would. If I were to zoom out again to the beginning of the week, Again, you can see technology it's been we're still down on the S&P. Industrials and energy, financials have been your biggest winners on this rebound. Technology, discretionary, communication services are kind of matching the market or lagging behind a little bit there. Again, aside from today, if I were to go all the way back to when we peaked on July 10th, so starting July 11th going forward, you can see that, again, like technology, like going into today, technology was your biggest loser, hence the big rebound. Same thing with discretionary, same thing to a degree with communication services. Those are still your three biggest losers. And so if the market's going to rebound over 4 days or, even just a 1 day, that's going to be the big reason why. Real estate utilities have been your biggest winners. They're actually doing pretty well, 5 to 7%. And they're kind of holding their gains to a small degree. Staples as well, kind of matching there with healthcare and then all your other cyclical areas. Again, these cyclical areas, when you look at them on their ratio charts, are negatively correlated to the S&P 500. So we really want to see these two back into the green. XLC is there. Meta, Netflix, and Google are in that particular category. So that's looking good. But these two big ones, Amazon, Tesla, and then those big three, along with like Broadcom and AMD, are in XLK, and they're still really in that lagging category. Man, they're not just in the lagging category; they're really down there. When you look at, let's see here, let's go to this energy one. When you're looking at again how far down that relative strength level got, that's again its lowest level that we've seen in a long time. It's really hard for it to go from such a low level back straight up to positive levels. I mean, we are well below the 50-day moving average, way more than we were in 2021 when it was lagging there. Again, you have to kind of go pretty far back to find the relative strength for XLK further as far down. I mean, these are some of these other levels that we had here, pretty low levels, and this has been the lowest. So it's not easy to go from such a low level up to such a high level, just like that. It usually takes, and it usually does so in fits and starts, which means we might get a little bit of a run of outperformance, but then, some weak momentum. See, the momentum itself still hasn't even gotten above 100. That's when you get into that improving category, is when the momentum gets above 100, but you're still negative on the relative strength. And once the relative strength also gets above 100, now you're in the leading category, the leading over here in this one. And so, we're still pretty darn negative on XLK, still way below that 50-day moving average. So it still has a lot of work to do. And remember, it's the other thing that we've talked about before is the ratio of discretionary stocks to staples, and how far away those are. Here's QQQ versus IWM, still below its 200-day moving average, which is another thing that has to break it back above that 200-day moving average because it's positively correlated. But this ratio, which is also very positively correlated, has broken down so hard and has not recovered very much like the rest of the market has over this past week. All right, well, that brings us to our trade idea of the day, and it's on Carvana. You see that this stock has been really sideways. It's been relatively bullish, but getting bull tags, but we've seen this before too. Not very much of a pullback there, and just really flat and really sideways. The intermediate lines in the neutral area, it's been pulling back. It's out of bullish territory, but it's not necessarily like we're getting bearish near-term peaks, but we're also getting bullish near-term lows. So we're not really getting bearish near-term lows either. The momentum line was extremely low yesterday on this bull tag, and obviously it's not bouncing back up like everything else today. When you look at its weekly chart, you can see that it's been pretty sideways, not really moving anywhere, pretty neutral candles, a lot of really small candles and transition type candles, but back to back to back, which means, again, that we're very neutral there. You can see from a 3 green arrow standpoint, and a volume standpoint, if I were to zoom this up, we've just gone from 3 red arrows now back to a green with very weak volume, and the MACD is very small, the histogram is very small, the The stochastics is in neutral levels, not really trending in one way or the other. You see that it's a very common pattern across a lot of these indicators. The DMI also is showing very neutral levels with both of those lines below 25. The RSI and the CCI are both sitting at neutral levels as well, right around the chart's midpoints. You look at the Ichimoku cloud, there's obviously no trend developed here. We had a slight bullish trend, but it's gone, so there's really no trend going. At least we do have a slight bullish bias, so that helps avoid any potential big weakness. The bandwidth is really small. We're right in the middle of the bandwidth. There's no momentum here. The bands are inside the Keltner channel, so that sets us up for a neutral trade, like an iron condor trade. So that's what we did. We sold the low 20 delta on both sides, bought one strike away, so it ends up being $5 wide. I think we ended up getting around $1.65 if I remember correctly. So we position size for a full position for a neutral, for a less directional trade. So a full $1,000 of risk and pretty decent reward. You can see the break evens end up being right around outside of the Bollinger Bands, right? So we do have break even below the lower band. So if we do break down, we probably don't want to be non-directional anymore anyway. So we'll probably end up making a directional trade if it breaks down. But if it continues to grind higher, we've got some room before we hit that break even up here. So it can continue kind of do its thing like it's done for the past few expiration cycles and just kind of grind its way higher and still stay below the break even up to the upside. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.